Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Bruno, welcome.
Thank you. Good afternoon, Paul.
Yeah, and listen, I think we're going to have another really interesting episode, and this time it's actually going to be more around your own home country, correct?
Correct. And not just my home country, my own university as well. So I know you guys like to talk about your Princeton journey, but I'm very proud to say that our guest Joe Nunes and myself, I went to the same university at the University of Waterloo.
Okay, we will not hold that against you, Joe.
So no, thank you. It's my pleasure and honor to introduce Joe Nunes. He is the executive chairman at Actuarial Solutions, and he has been there for a couple of decades. So you started that about three decades ago. Joe, welcome.
Thank you. Happy to be here.
Oh, thanks, and thanks for accepting our invitation. And can you start with maybe walking us through your journey? I mean, you started this firm 30 years ago, been in the actuarial consulting field, mainly on defined benefit pension plans. So you've seen this shift. You've seen some of the and at the very forefront. What retirees have, what retirees don't have, what pre-retirees need. Can you tell us a little bit about how you got involved in this in the first place?
Yeah, so if you rewind the tape, 39 years ago, I wrote my first actuarial exam and went to work in my first co-op job with actually the province of Ontario. At the time, the group I was working with were doing the actuarial evaluations for the teacher's pension plan in the public service. I will confess that I had no firm understanding of the mathematics and programming that we were doing, but that's where I started. And in 87, I went to Mercer as a co-op student. And at the end of 88, I was full-time at Mercer. And that really is the beginning of my, private sector defined benefit plan education. Left Mercer, spent 3 years at a small brokerage, insurance brokerage, doing DB pension, but also a bit of health and welfare work. And then 27 years ago, started this little adventure under the premise that plan sponsors with smaller mid-sized pension plans just needed something a little bit more boutique than the Mercers and Willis Towers Watson. And to some degree, I was proven right over the 3 decades we've been marching down this road.
So obviously through this journey, through this work, obviously, you deal with corporations, employers who offer those type of plans. Can you talk to us a little bit about the evolution over time from the needs of pre-retirees and retirees back then and those needs today?
Yeah, well, I think, it's no secret, and I'm sure you've covered this in past episodes, but it's no secret that starting in the late 80s and early 90s, somewhere between, changing legislation and complexity and accounting rules, private sector DB plans started being phased out, defined contribution plans started to come in as the popular replacement. And so that journey parallels the journey of the pre-retiree, because again, in the early 90s, the pre-retiree might have had 30 years of service in a defined benefit plan and 2 or 3 or 4 years in a defined contribution plan. So the defined contribution was not, a throwaway is probably the wrong expression, but it certainly wasn't the big focus of, can I afford to retire? You weren't looking at that bucket of money. You were looking at your annual pension from your DB plan. And obviously now we're close to 40 years later, we're facing the opposite, where many people retiring in the private sector uh, have 100% DC. They don't have any DB. There's some with DB, and some of those DB people have DB right up to retirement, but some of them have a frozen DB that only covers half or a quarter of their service.
So, well, I have some cross-border questions, and here in the U.S., obviously the U.S. There are a lot of parallels between what's taking place in the Canadian retirement market and the U.S. Some differences. I really like to get your perspective on that. But if we kind of go through here, my perspective, Joe, is our in the U.S. Sort of the movement from DBs to DC, I would say was okay. Yes, it did make plans portable. People have saved, but when you look at the actual numbers, I think the average 401k balance is kind of unfortunately Bruno, pathetic. A lot of people, when they leave their jobs, make the wrong decisions, cash their 401ks out, and um, you look today. Arguably we've got quite a retirement crisis brewing here. Did it work better in Canada by putting the investments options in people's hands?
Did it work better? Is that what you're
Yes.
asking me? No, I think again, I sort of jumped into the DC business along with starting this practice because, um, again, that was the wave. We started this in '98, and the wave of converting from DB to DC was underway and continued. So I've had a lot more involvement in DC plans, and what I'd say to you is that to me, the single biggest failure of DC has been the contribution rate. And when we look back, like I remember being at Mercer, and sorry, I got to turn this off. Um, I remember being at Mercer in the very early '90s and doing sort of illustrations of DB to DC, and of course, let's assume the DC plan generates 6, 8, or 10% a year, um, and the DB plans over here with discount rates that were applicable in the '90s. And so you designed the plan out and you said, you know what, if the employee puts in 5% and the employer puts in 5%, and you're here for the whole career, you're going to replicate what you would have got out of the DB plan. And if you looked at the DB plan actuarial valuations back then, yeah, you know what? The employee was paying 5%, and the employer might have only been paying 3 or 4, maybe they were paying 6. But the 5 and 5 model was somewhat reasonable in 1990 based on long-term bond rates and projections of equity returns. And what's happened is that there was just this a continual march for a couple decades of declining interest rates. And, we would go to our DB clients and we'd say, hey, you're going to need to put more money in. You're going to need to not only contribute more per year for accumulating service, but you're going to need to put in special payments to make up past ground that's been lost. And for DC plan sponsors, often they didn't work with an actuary, they didn't get any advice, and they just sat on the 5 and 5. And some got away with sitting on 4 and 4 and 3 and 3. And basically, my conclusion, the failure of the DC industry has fundamentally been the first and foremost the lack of adequate contributions. Because if you only put in 3 and 3 starting in 2000, you can pick the top quartile fund and you're still not going to get there.
That's interesting, and I was expecting, and I'm sure you're going to have some thoughts on that as well. But I was more expecting that the lack of income produced by DC plans where was mostly the largest shortfall of the DC plans. But I hear you. If there's no money to redistribute in however shape or form, that's an issue as well. So I completely understand where you're coming from.
Yeah, well, the end result, like again, I'm telling you what the problem is. The end result is inadequate retirement income for people reaching their 60s, right? That is the problem. But I'm giving you the root of the problem is if you don't put enough money in, we can spend a lot of time talking about, which equity fund, which foreign equity fund, which bond fund. We can spend a lot of time on that. But if you're putting in 6% of pay in total, and I've had clients in the past like that, 3% employer and optional employee contributions, and a lot of people saved 3% a year.
Yeah, it's we have a lot of issues I think to address as a society across I think in both company or both countries. And Joe, maybe you could just for my edification, share with us your similarities and dissimilarities between sort of the U.S. and Canada. It sounds like in collectively we haven't put enough or created a situation where enough citizens or workers are saving enough. I mean, what else is similar? What else is different in the two
Yeah,
countries?
well, let me start by saying I'm not really expert in the US. I have spent my whole career here in Canada, working on Canadian plans, so from Canadian tax point of view, etc. Um, but to me, my understanding is always that your 401k regime is basically matching our defined contribution pension regime, and you guys are just always a little bit ahead of us in terms of innovation. And so when we started converting to DC, we were getting messages that the U.S. head offices had already converted their U.S. plan, and now they thought it was time to convert the Canadian plan. And so it was something that you know I don't know that we're copycats, but we've certainly trailed you in some of those changes.
I personally have one of each, so it's I could tell you they're fairly similar. At the end of the day, you have a DC plan is it's basically an account balance with funds invested in some funds. So I think the you know my question was the more around what does the future look like? What is the missing piece? What can be added to DC plans in order to make them adequate, to make them more sound, or just outside solutions. I mean, people can save money outside of employer pension plans as well. So my broader question is like, what can society or what can the private sector offer in the broad in the broad system to help retirees and pre-retirees?
Well, I kind of I'll tackle that in two buckets. I think the pre-retiree, um, we've had a really nice evolution. It's just been slow, but we designed, in the early 2000s, we came to maybe even the late 1990s, we came to risk-based funds or life cycle funds, where you were taking on a certain level of risk, and you tried to persuade plan members when you're young you should be more heavily in equity, and when you're closer to retirement you should be more heavily in fixed income, and trying to move away from the 50 fund menu where someone that doesn't really understand investing needed to go and decide which of the 50 funds they needed or which five of the 50 they needed to put together to have a good portfolio. So I think that was one good evolution. And then following that, we came to the target date funds, which really are still in place today, as a solution for people to just basically say, you don't have to be an investment expert. Tell us your birth date, we'll put you in a fund, and we'll manage your investments from beginning to end. And so I think that's been a good evolution. Maybe the downside of that is it isn't customized enough to each individual's, net worth, uh, income trajectory, risk tolerance. So you lose some customization with those funds, but probably for 80 or 90% of plan members that really don't know how all this works and don't want to know and just want to have something, some sort of reasonable glide path, if you will, that's been a good solution. Um, on the retiree side, and I've been saying this for almost 15 years, I'm pretty pro annuity, and as you guys know, I should disclose that I've made a small investment in a US tech company that's trying to uh, enhance the defined contribution space, the 401k space with in-plan annuities, and the idea that it's not an all or nothing purchase. It's that, people find it really intimidating to reach retirement. They got $370,000 in their account, and someone says you can either keep investing that for your lifetime, or you can buy an annuity with 370,000 and convert that into, X dollars a month. And people find that to be an enormous decision. And so I think, the folks that I've invested with have this idea that people should, starting at 50 or 55, start to incrementally buy 10 and 20 and $50 a month worth of income and build up that income slice while they continue to grow the long-term money in more of an equity type investment. And that's coming in the US. The US is, the one thing for your listeners that's different in the US and Canada. In the US, you've got investment managers, you've got record keepers, you've got insurance companies that sell annuities, and these are often very different and large and well-established entities. In Canada, the record keeper market really bundles in the investment managers a lot. Sometimes it's proprietary funds that the record keep. The record keepers are largely the insurance industry in Canada, and they'll bundle in investments. They'll bring in a T. Rowe Price or a Fidelity, but it will be sort of bundled in on their platform. It won't be that you'll go get a contract with Fidelity as your investment manager and separately get Canada Life as your record keeper. You'll just hire Canada Life, and they've already put the investments on the shelf. And we don't really yet have the in-plan annuity structure built into the record keepers, so we have to do those as one-offs. We have to, the plan sponsor on the DB side has to go contract with an annuity provider directly to put the annuities into the plan. And we don't really have it on DC yet, but I think it's coming. It's coming in the US. It's already being built into some of these leading plans in the US, and it'll be here in Canada in 3-5 years.
Well, it's obviously we've seen a lot of interest here in the U.S., Joe. So it's we've had a few people, key players, on the show. People at Marcuity. We kind of go down the list. I'm not sure. I think you give too much credit to the U.S. because I think we're still figuring this out. Some key players have made some big bets, but we've seen the target date fund approach, kind of with this, with the annuity bolted on. It's unclear to me, and you probably have a better sense of, how portable are these annuities? Like, if I leave my employer, can I still put my money into that account or not? How close, since you've got investment in this company, how close do you think we are to saying this is the winning product design?
Well, I've placed a small wager with my own money that it's the winning product design. But I will agree with you that there's other people out there that think that there's different designs around these decumulation pools or these longevity pooling programs. I've done a fair bit of homework looking at that, and I understand it, but basically the attraction to those pools is, well, the detraction to annuities, people argue, is they're very conservatively invested because the insurance company is guaranteed this income every month for the rest of your life. And so they can't really get out there and put 70% of that money in equities because it just would wreak havoc on the balance sheet and solvency of the insurance company. So they have to invest very conservatively, which is why a lot of financial advisors will say, well, annuities are really expensive. Because if you take an Excel spreadsheet and you project a DC plan with equity returns, you say, hey, you're going to make 7% a year, but if you buy this annuity, you're only guaranteed 4% a year, then you kind of look like an idiot to buy an annuity. But what you discover with these longevity pools is that the payments aren't guaranteed. And so they'll target a higher payment than your annuity will guarantee. Um, but guess what? There's going to be volatility in what you actually get, and you may get more over your lifetime than you would have got out of an annuity. Um, and maybe it's more probable that you get more than an annuity over your lifetime if you live long enough. But the ups and downs may be something that you can't stomach. And so my whole premise is the point of the annuity is for the person that needs some guaranteed monthly income to pay rent, groceries, gasoline, property taxes, whatever those things are that you've got those monthly costs. The annuity is what lines up to, guaranteed outflow of money every month. How about guaranteed inflow of money so that we're not having someone turn off the heat?
But to your point, should that be, not a all or nothing proposition, as you mentioned? Could it be like some small buckets of each, and then building out your portfolio not just of assets but also of income? And yes, part of it is guaranteed, part of it is volatile, part of this is very volatile, but you have you have that ability to juggle between, or have access to those
Yeah.
different type of solutions. And the one solution is whatever fits right for you, but it's a combination of both. And I completely hear your mindset on, if I'm retired, I have $300,000 in the bank. I need to take this decision now. That's not the right approach. That's not the right the right mindset. You need to build things over time, for many reasons: credit reasons, economic reasons, and just plain understanding of
Yeah.
this whole playing field.
Yeah, no, for sure I agree that, I mean, to me, this is the design of the 401k, the DC plan in Canada. If members can remain in the plan after retirement, because in Canada, typically what we've done is we sort of push people out of the plan if possible at retirement. Some lawyer 20 or 30 years ago said to a plan sponsor, do you really want the fiduciary duty of, worrying about the investments of someone that no longer works for you and creates economic value? And so there was a long history of pushing people out of DC plans. But I think people are starting to recognize a couple things. First of all, if you keep all that retiree money in the plan, from an economy of scale point of view, you might get some better investment fees for the active employees as well. Uh, and the second thing is that is your duty to a long service, valuable employee over the day they walk out, or you kind of have a little bit of a duty to help make sure that that money lasts properly. So I think that attitude's shifting. But my point was, I think it's like a layer cake, right? At the very bottom, you're going to have your Social Security, um, and then you may have whatever individual annuities that you purchased outside of a pension arrangement, and then you've got a pension that might have a DB piece, might have a DC piece that you've converted to an annuity, might have a segregated fund that's still invested in equities, and you've got these layers, right? And like one of the things, like I'm very negative on Bitcoin, um, but if someone wants to be in Bitcoin and they want to take that top layer, that top 0.5% or that top 1%, because they're absolutely convinced that Bitcoin is going to be the winning formula in the next 10, 100 years, um, then to me, there's that layer at the very top that's very high risk, high reward. But if you lose that 1%, you want to make sure that the 99% still means mortgage is paid or rent is paid and groceries are paid for, and those types of things. You don't want to be risking an amount of money at age 70 that all of a sudden you have to go to your spouse and say, listen, we had a bad year with our investments, and so next year we can't go to restaurants.
Yeah. Well, let me push that. Yeah. Let me just. I just want to pull that a little more because there's some controversial options on the table, at least here in the U.S. So, your comment about Bitcoin and assumptions about growth rates are really interesting. I remember, Joe, when I started my career, I started for a then mutual insurance company. I remember sitting in a meeting with the chief actuary who was looking at the pension assumptions, and his discussion, it was they're taking the implied, I think, interest rate assumption, if I remember right, down from like 8.5% to 8, and it was going to cost like an enormous amount of money on our income statement to make up for,
Right.
make up for that. Now, where are we today? So, one way out is, well, if I can't change their contributions, let me make bigger bets. You mentioned
Right.
Bitcoin. Now, there's some others that are on the table today, like, hey, let's let private equity pull up, either manage the funds or start to put alts. What's your perspective on that?
Yeah, boy. I'm relatively negative on private equity inside of pension funds, whether it's DB or DC. I'm not saying it doesn't work and it can't be appropriate, but I think that, and I forget who came up with the expression. I think Bruno knows, but volatility washing. I just love that expression. Whoever came up with that, and to me, private equity, sure, if you only find a price of your underlying investments once a year or once every 3 years, you revalue it, and the rest of the time you just interpolate, it's going to look pretty low volatility, but I'm not sure that they are. And the best example I had an actuary share with me, we had during I guess it was around COVID when everyone went to work at home. Commercial real estate funds plummeted like 19% or something like that, and then one of our big government pension plans reported that their real estate portfolio went down 4%. And it's like, well, wait a minute, isn't their real estate portfolio the same commercial real estate that, we're investing in our RSPs or whatever? And so it just shows you that a lot of this perceived great value that you're getting from private equity at a lower volatility, maybe that's not true. Maybe from a Sharpe ratio point of view, you're getting more return over the long haul, but you're taking more risk to get it. So something to think about there anyway. I think the other thing too is that from a complexity point of view, I think if these are options, and someone's heard that private equity is better than something else, and like you say, people are chasing returns, and then they don't really understand, well, we're getting more return because we've got more risk, and in particular we've got liquidity limits, and then someone wants to get their money to move it to a different investment, but guess what, you can't take it out right now because we don't have the cash flow. It's a relatively sophisticated investment. I don't think it's for the average employee that's got 127,000 in their 401k.
Okay, so now the other extreme. Okay, if we can't we can't get higher returns, what if we start saving earlier? Now, we have this one big, beautiful bill coming through Congress, and buried in there is this savings account for kids. I actually like the concept, which is, I think the government would put in $1,000 at birth, and then allow families to contribute $5,000 a year, until I don't know, some age. It's
Right.
It was called like a MAGA account. Now it's called the Trump account. Trump
Okay.
account. Is this? Is this a real solution? I mean, it certainly would take a lot of time to build up, but is this another approach? Just same money, but just let's start 18, 19, 20 years earlier.
Yeah, I have no objection to any regime that encourages people to start saving at younger ages, recognizing like the whole idea of retirement is kind of modern, right? In the old days, you worked often till death, and if you got into the part of life where you sort of helped out on the farm, but you weren't the primary farmhand, because you were now 65 or 70 and they let you collect the eggs or whatever, you were still kind of working. This idea that, at 57 years old or 62 years old, I'm going to completely stop contributing and just drain down some basket of money that I've built up over 20, 30, 40 years, like this is a very modern idea. And I don't think it's that workable. So, sure, if you want to start younger and saving younger, I think that can help to create that saving habit and that discipline. I'm not really Sure. Like to me, one of the things that people also miss is administrative costs. And so to me, the more we can get, you know, big programs that have economies of scale in terms of their administrative costs, in terms of driving down investment costs, per dollar investment, et cetera, that will help. Um, and so if the government's going to create something with small dollars in it, and employers over here have medium dollars, and then Social Security has some in the U.S. Social Security has some pretty considerable contribution rates. I imagine up to a wage limit, and so then you've got that bucket. Like how many buckets do you need, kind of thing. And then you might have three buckets with three former employers, right? So
Interesting.
Indeed, and I have a couple of myself, so it's they add up, and I hear what you're saying. The administrative part of it can be a huge factor in the equation, and just the personal management of every single one of those can be it can be a nightmare
it's
as well.
both. It's if you can combine two accounts and only have one account fee, that's like an economic gain. But then there's also just the paperwork, the forms coming into your home saying, don't forget you've got this money over here and you've got this account over here. And I know my wife and I talk about this. I've been at the same employer for 27 years, and we still have a little bucket over here from Mercer, and we have this over here, and we have something called the tax-free savings account. So now we've got two of those buckets, and so I think a lot of people get mentally exhausted if they've got their money in 4, 6, 8 buckets. They don't want to sit down on January 1st and add all the buckets up and figure it all out. And you find people tuning out and just saying, well, one day I'll be able to afford to retire, I hope. And
Well, yeah, listen, I agree. Uh, a prior employer, I set an incubator up in the Hartford area. We were encouraging a lot of startups in the retirement space to come and be part of it. And we had some great ideas, different variants of, sort of uh, a recurring premium type of annuity. Save a little bit. It was kind of like the idea of putting the annuity in the retirement plan in the DC before the DC came. But Joe, to your point, it was really, really hard to get insurance companies interested because how much does it cost to set up an account? Okay, anywhere from $60 to a couple $100 to set this thing up, and then there's a fee every single year, and you're running that against little tiny accounts that may lapse. Maybe they've made 2 years of payments and they've stopped. So I think this is where technology, I think, can improvements in technology can really help, right? Why shouldn't it cost 6 cents to start an account, right? Well, let's see. We're close to the top of the time. I don't know, Bruno. What are any final questions or thoughts?
Well, the last one. Any thoughts on the future of lifetime income sharing pools? Do you see them outside DC plans? Do you see them inside DC plans? Do you see them at all, either in Canada or in the US?
Yeah, I don't think that they're going to have much mileage. Um, when I was young, someone said to me, insurance is sold, not bought, and it's a relatively complicated product. Um, these longevity pools are way more complicated than an annuity, than a 401k account, than a mortgage or a bank loan. And I just don't think people are going to I don't think the average person is going to have the ability to really kind of absorb the risk reward paradigm. And so the only way they're going to take off is if people can successfully sell people. You don't need to fully understand this. This is good for you. And I think, did Purpose Investments close theirs in Canada? I can't remember. Maybe it was Guardian. I thought someone discontinued one of their longevity funds because they just weren't getting the pickup. And the other thing is, these things need to be big. Like, you're kind of in a catch-22. You want to start a fund and you've got to sell it to the first person and then the first 10 and first 100, but you need thousands. And so what you end up with, like the purpose one, I think had 3-year age bands, and both males and females were in the same cohort. So, the 54-year-old female's in with the 57-year-old male. Um, and when you start to look at it, you start to say, well, this is a good deal for the 54-year-old female. They all jump in, but then now it's not a good deal anymore. If the only people in the cohort is 54-year-old females, the only problem is you're probably all going to live longer than the projected mortality table. And eventually, someone's got to start cutting benefits unless the investment returns can sort of go past the hurdle rate to compensate for that. So think about how complicated what I'm saying to you is. Um, what plan member is going to kind of understand how all this works?
Yeah, but on the flip side, how are you going to tackle longevity risk? I mean, so
This
it's
is this is why I'm pro annuity. I'm like, okay, what does an annuity do? It solves the longevity risk. And if you want, and you feel like you can't afford to invest in a bond-like return in a fixed annuity, well, then there's going to be the variable payment annuity that's going to have some sort of equity fund backing it. And you can do that, and it's going to go up and down like this. Um, but it won't be that hard to explain. The idea of trying to level it out with the pooled longevity funds and have it slowly rise or slowly decline as people drop out due to death, it's a level of complexity that people don't need. Either you can't afford volatility and you need a life annuity locked in, or you can afford a bit of a volatility and you take the variable payment, but your value goes up and down every year depending on what your fund did every year. There's no smoothing of the investments between cohorts in those plans.
Yeah, interesting. Well, I guess with that, Joe, this has been fascinating. How could people, find you, reach out to you, and also learn more about the company you have in the U.S.?
Yeah, well, Bruno has my contact details. We're here in Canada, but for the most part, we're not marketing to individuals. One of the last things I'll say is I'm very pro professional advisor, whether it's someone that has investment credentials largely and can do some planning, or whether it's someone that's got planning credentials but can help with investments. Um, but I'm very pro people getting help. The catch is you need to kind of generate a pool of money to be able to afford to get that advisory help. So, if people are listening and they're just, starting on this journey to save for retirement, bottom line is save as much as you can early. Um, play with the online calculators to try and figure out, you obviously don't want to save so much that you're retiring at 37, but you've lived poorly for, 17 years since you left school. But there's an amount of money between 10 and 20% of your pay that somewhere in there you're gonna get to early retirement versus be okay at age 65 or 68 and start building your nest egg. And if you can do that when you get to age 40, maybe you can have a professional advisor that can sit with you and say, oh, I see you've got $500,000 now, I see you've got $750,000. Let's sit down and make a smart plan. Let's start thinking about taxes, and let's start thinking about longevity and when you want to retire. um, and then the last thing I'll say is that it's not all doom and gloom, because what people I think underestimate when they're designing these plans and selling these plans, people have a massive lever in retirement date. And so if people kind of hope to retire at age 60, but they get to 60 and the income isn't there and it's not lining up, they can work to 62 or 65. People don't necessarily want to. And so now if you're 30, you have a choice. You can either really proactively plan to be ready financially at age 60, or you can take your chances and worry about retirement later.
Yeah. Well, listen, Joe, thanks so much for your time. Bruno, great as always to have a conversation like this. We want to thank our listeners. Be sure to leave us reviews, give us a 5 stars, but most importantly, come back next time for another great episode of That Annuity Show. Thanks.
Thank you.
Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com.